Today we will present you contingent capital primers. Contingent capital primers, or COCOs, are bonds that get partially or completely converted in shares on the occurrence of a certain event. The event, or trigger, is usually the capital ratio of the bank reaching a certain point. In this way, if the bank is going through a period of distress, the removal of the debt will help her get back on her feet. Since the reach of the trigger means a condition of distress, having the bond converted to stocks is not a favorable case for investors. To compensate them for this possibility and to make COCOs attractive, banks have to issue them with higher yields than regular bonds.
The COCO bonds market has increased dramatically in size during the last 10 years. The first issuances took place just after the 2008 financial crisis, because banks needed to shield themselves from capital losses in case of adverse conditions. This is why contingent convertible bonds were born. In 2014, with the Basel III regulations capital requirements, the market had a huge increase. As a result, the amount of COCO bonds outstanding as of 2014 is more than 70 billion euros, from more than 20 different issuers. In order to get a sense of how big the COCOs market can grow in Europe, we could consider the fact that the largest banks would like to have around 1.5 to 2% of their risk-weighted assets filled with COCOs. The 1.5 minimum requirement is based on the Capital Requirement Directive, CRD4, which came into effect in 2014 as part of Basel III. As a result, it is easy to see the European COCOs market growing to over 200 billion euros. The Basel III Accords require banks to have a minimum of 4.5% of Tier 1 capital among its risk-weighted assets. Tier 1 capital mostly includes common stocks and retained earnings. Tier 2 capital contains undisclosed reserves, re-evaluation reserves, general provisions, hybrid instruments, and subordinated term debt. In order to generate more capital to fill the gaps and reach the required ratios, COCO bonds can be used. This gave birth to AT1s, which are additional Tier 1, callable perpetual maturity COCO bonds, with triggers that are linked on the Tier 1 capital levels, and AT2s, which are additional Tier 2, fixed maturity COCO bonds with triggers linked to the Tier 2 capital levels. There are a few reasons why banks issue COCO bonds. COCO bonds are the first line of defense against big capital losses, and they are crucial to avoid another Lehman Brothers-like collapse, like in 2008. They also allow for risk to be transferred to private investors instead of sovereign states. They also fit perfectly with the capital requirements of Basel III regulations, and they allow the banks to adapt as Pillar 1 and Pillar 2 minimum capital definitions keep widening. They also help better the bank's rating.
When investing in COCOs, we have to take into account several factors. First of all, we should keep in mind that COCOs are deemed too difficult for regular investors, so they have a high minimum investable amount. Then, we should consider the characteristics of the COCOs as obligations: coupon, maturity, call dates, and call price. If we look at the rating, we should keep in mind that the COCOs have different and lower ratings from regular bonds, since the suspension of the payments is associated with a trigger, an event much more likely than a default. To access information on the trigger on Bloomberg, you can click on Additional Information. The informations include the index associated with the trigger, which is usually the Tier 1 capital ratio, the trigger level, so the level or index for which the conversion gets triggered, and the kind of conversion, which can be partial or complete, or, as in the case that we are seeing, a reduction of the principal.
After it is issued, a COCO bond behaves like a fixed income instrument. It pays regular coupons to the lender until the maturity is reached, or in case of a perpetual callable bond, like an AT1, it pays coupons until the security is called. The principal is then reimbursed. However, if the capital ratio trigger is hit, or the regulator decides that the bank has reached the point of non-viability, then, depending on the specifications of the instrument, either the principal is partially or fully written down, or it is converted into the bank's equity, in which case the COCO bond starts behaving just like regular equity.
Let's now take a look at two examples of COCOs. As we can see, while they come from the same company, UBS, they have different ratings. This is due to the fact that they have different debt ranking and that their trigger is different, as we will see later. They have one major difference, which is that the first is a bullet kind of bond, so with the principal that gets paid at the maturity, and the second one is a perpetual kind of bond with an embedded call option. About the trigger, we can notice that while they use the same index, so the common equity tier 1 ratio, they have different trigger levels. So the first one has a 5%, the second one has a 7%, which means that the second one is much more likely to be converted.
To sum this up, CoCo bonds have a lot of advantages. They deliver a high yield to their investors, while also having potentially greater than 100% recovery ratios if the equity of the bank recovers after the conversion. They allow banks to follow the Basel III capital requirements while being cheap to issue because of permissive taxation, and they can be used as variable salary to the employees of the bank. However, they remain complex instruments, hard to price and highly risky, which is why they are inaccessible to the common retail investor. They are also subordinated debt. Thank you for your attention.